going to move quickly to the issues affecting the end users. And Doug Elliott, a partner at Oliver Wyman and in the financial risk and public policy areas, formerly a fellow at the Brookings Institute, and before that an investment banker for 2 decades prior to Brookings, and a long time ago, friends up on the Hill together. So thank you, Doug, and I'll let you introduce your panel and talk about end users.
All right. Thank you very much, Bill. And Bill is one of my favorite people in Washington, I have to say. I'm not sure how many of you have had experience with him where he's gone out of his way to be helpful, but it numbers in the thousands of people, I'm sure, here in Washington. So let me make just a couple points of my own before I move on to introducing the panel, which is at Oliver Wyman, a fair amount of what I've been doing of late is working with the whole team on the LIBOR transition. And what's clear to us is that, as has hopefully already come across, this really is a big deal. And second, that the financial institutions we're working with are largely behind. I would agree with what Scott O'Malley said earlier, which is, yes, progress is being made, but there's a long way to go. Now, the derivatives market is probably further along than almost everything else. And also, please keep in mind, as you hear people here, everybody that you're going to hear from knows this topic well, and their organizations are generally the more advanced. There are a lot of people out there, a lot of organizations that are not nearly as advanced. And this is a concern to us. And while I wouldn't want to take away from what Dave Bowman was saying, he's right, we can't know the future. I am willing to make quite substantial bets with you that by January of 2013, so I'm giving myself a little over a year margin, LIBOR will largely be gone. So, and to give you very briefly my perspective, this in many ways is in the hands of the Financial Conduct Authority. Because yes, the US can go its own way, but the litigation risk is going to be massive if, as is quite possible, the FCA in the UK says this is not an adequate rate. So I don't want to take up too much of the total time, but I'll also mention, I'll leave a number of copies of our own version of paper explaining where things stand. I'll put them over there somewhere after Commissioner Benham speaks. Now, we have relatively limited time, so I will go very briefly through the intros of the panelists. They're all much better than I will make them sound, because I'm just going to give you the briefest explanations of who they are. I'm going to go through in the order in which I will then ask them questions. And we have, at this point, about 20 minutes, I see, for the panel itself. So I'm going to have to be a little bit ruthless with everyone on their answers, and I apologize to all of you for that. So starting, Meredith Coffey, to my immediate left, is at the Loan Syndications and Trading Association. She's an executive vice president, and she runs their research and analysis department. And as was mentioned, she is on the ARC. Syra Burke, I would say you're nicely in order, good job, is at the Structured Finance Industry Group, where she is senior policy director. Jason Mankey, and I guess here we are out of order, all the way at the end, is at MetLife, where he's a senior managing director and head of global derivatives and liquid markets. And then finally, Wells Engeldow is at Fannie Mae, where, unless he's been promoted very recently, because I haven't checked, is vice president and deputy general counsel. So thank you. So Meredith, let me start with you. You focus on loan syndications and obviously the broader loan market. So how is the loan market preparing for the possibility that LIBOR may no longer exist? And what do you see as the key issues?
So, I mean, we have to do first things first. And the first thing that we are focused on is the syndicated loan market, and actually Victoria kind of mentioned this in some of her fallback questions, is the first thing we need to figure out is if LIBOR went away tomorrow, what happens to the $4.3 trillion of syndicated loans outstanding? What happens in those contracts? And the first thing that we've done on our ARC working group is say, okay, we need to develop robust fallback language that explains if LIBOR went away tomorrow, you know exactly what your rate falls back to. As a result, in our working group, we have put out a consultation after much work that makes recommendations about how fallback language should look in syndicated loans. We've spent a lot of time being very focused on making sure that our recommendations are workable, that they can be executed en masse, that they reduce systemic risk, and that they are as fair as possible. So we're not transferring value from a lender to a borrower or vice versa. And we feel like that is by far and away the most important thing that we can do right now. Once we can get that fixed, then we can start looking at, for instance, putting SOFR into new documents. But that's our first effort.
And what do you see as the unique issues with loans as opposed
Sure.
to some of the other
Sure.
areas?
Well, there's a couple things on loans. People say, for instance, well, loans need to be priced over a bank's cost of funds,
Right.
for example. That's not exactly right. So if you look at the $4.3 trillion syndicated loan market, about $1.2 trillion of that is provided by non-banks. So they don't need a bank cost of funds concept. If you look at another $2 trillion of it, these are lines of credit that are unfunded. They don't need to be done over a bank cost of funds. The remaining $1 trillion outstanding is a funded loan that is funded by banks. In theory, that would be nice to be done over a bank cost of funds, but the reality is LIBOR is not it. Banks do not fund themselves at LIBOR. They fund themselves through deposits, longer-term securities. So it's really LIBOR is not the cost of funds concept. So I think what we can do is we can transition over to a new rate like SOFR, perhaps put a spread adjustment into it so that it looks a little more like LIBOR for new loans. And for the rest of the market that isn't reliant on banks for the funding, they simply don't need that bank cost of funds concept.
And I'm curious about one issue, which is, while you're right about the cost of funding of banks and of the non-bank players, at the same time, LIBOR right now, which they're used to, has both a certain kind of average spread, but it also has a level of volatility around that spread. It's a squiggly line, it's not a straight line. How do you think the loan market can best adapt to moving to something that doesn't squiggle like that?
To be fair, SOFR does its own squiggling,
Not
but
as much,
a different
though.
kind of squiggling. Yeah, so one of the unique attributes for LIBOR is that in periods where there is stress in the credit system, bank cost of funds go up, LIBOR goes up. SOFR will not do that. SOFR will probably be flat or even go down in periods of credit stress. And that is something that we have tried to deal with in the context of syndicated loans. There's been a lot of discussion about should we have a dynamic credit spread adjustment, for instance, between LIBOR and SOFR. And ultimately what we decided was that probably doesn't make sense because that just kind of replicates LIBOR.
Yeah.
Instead, I think we have to kind of accept that perhaps there is a little more risk in the system if we go to a fixed spread adjustment. So I think that is one of the issues that we have to acknowledge as we move forward to a better, more robust rate.
All right, thank you, Meredith. Unfortunately, I have to move on. So, Sarah, let me ask you a similar question. How is the securitization market preparing for LIBOR possibly not existing, and what are the unique issues there?
Sure. So similar to Meredith, and we are farther behind, but estimated along with PREPC, co-chairing the securitization working group within our focusing on trigger language, fallback language, and just to level set a little bit, in terms of exposure on the securitization side to LIBOR, very much dwarfed by derivatives. It's about one and a half to 1.8 trillion, but it's still trillion. One concern we have, and this is related to why we're working so hard on these fallbacks and trigger language, is that while you do have maybe 700-800 billion expected to mature by the end of 2021, with every deal that's done every single day that doesn't have appropriate language around LIBOR discontinuance, you're just increasing the LIBOR exposure. So we're working really hard on trying to come up with an industry consensus on what makes sense for triggers and fallback languages. In terms of unique aspects of securitization, I think a lot of it comes down from the various moving parts. You have the securities, you have the underlying collateral, and you typically have derivatives hedging the deals. So, and we're happy to have a little more time for the ISDA consultation, but one thing a lot of our members have been coalescing around is the need for, within a waterfall, a priority given to a forward-looking term risk-free rate that would mimic LIBOR as much as possible, but of course SOFR derived. That being said, and then you're looking at the loan side of things. I think there's a lot of debate in terms of on the retail side, on the loan side, where potential fallbacks will go. And there's in those contracts, it's obviously not standardized at all, But we would think that a lot of borrowers would again want to fall back to a forward-looking term rate. Going back to either a backward or forward-looking average or compounded risk-free rate, overnight risk-free rate, is something that might be confusing to them, somewhat distressing to them if they don't know well in advance what their rate will be. So you have potentially securities moving back to a forward-looking term rate, loans potentially moving back to a floating forward-looking term structure, and then on the derivative side, moving sensibly back to more of an overnight structure. So then you have a lot of basis risk there. So that is something our members are sort of laser focused on. And then I think just one final thing, in terms of triggers, ISDA has two key triggers. The floating rate notes group, as well as the securitization working group, thinks there are some scenarios which would require pre-cessation triggers. For example, in the case of securitization, you could have a trigger where if you have a certain percentage of the underlying collateral that is converting over to SOFR, you would automatically have the securities convert over to SOFR as well to take some discretion out of the decision making. In that scenario, you would have, your loans and securities have transitioned, the derivatives have remained LIBOR based. Then you have a whole host of questions on kind of related to the variation margin issue. So you have derivatives that are linked to an old rate. So LIBOR, what are you going to do? Are you going to, close them down, open up new derivatives, and that, introduces you to variation risk and then risk of downgrades for the overall deal. So just a lot of moving pieces we're trying to figure out.
Let me just say I'm glad I don't have your job. I do think it's one of the harder transition elements here. So Jason, your firm is both a big fixed income investor, really large in fact, and an issuer of debt. Can you share your perspectives on the market's evolution of LIBOR?
Yes, I think the market evolution has gone quite well thus far. I know there's some naysayers out there that early on wanted to compare the SOFR futures contract to Bitcoin futures. Well, we surpassed that milestone back in the summer. But I think it's important really to look back on when we started. You have to recall that we just had the rate be published in April of this year. So we've come a very long way in a very short period of time. If one asked me, back in April, when would MetLife issue a SOFR-linked liability, I'd say, sometime in 2019. We've already hit that milestone. We issued $1 billion piece of debt this summer. So I think we've made very, very good progress. I think there's clearly more work to do to develop the markets. I think the important part is education and getting the word out and doing the preparation. I think as more market participants realize that they can't keep their head in the sand and focus on transitioning, identifying exposure and transitioning, the more they will do test trades and things to increase market liquidity. So I think that will come. The other thing I think that has to happen is that the prudential regulators actually have to ease the transition by not penalizing commercial end users or end users from transitioning to products like derivatives linked to SOFR. And what I mean by that is there's a lot of legacy contracts out there, particularly in the derivatives market, that are linked to LIBOR. We shouldn't want the market to wait till there's a trigger event. We should want the market to move earlier. But there are some potential fallbacks of moving earlier in terms of bringing those legacy transactions into the new regulatory regime. So I think the prudential regulators could help the market by exempting those transactions.
Can you give one example of that?
Some of the uncleared margin rules and swaps. There is some concern that if you have a legacy swap agreement that was done pre-implementation of those rules, that if you were to modify the contract at all, it would bring it into the clearing regime, and the uncleared margin rules would take effect for that legacy trade. So that's something that could be solved by the prudential regulators and give an incentive to the market to move to a SOFR-based index for legacy transactions.
And then more generally, representing a firm that's both an insurer and an investment manager, are there special issues for your types of firms?
So as at a base level, I think most financial firms are similar in that you have to identify exposures, you have to work on fallbacks, you then have to implement, and you have to do a lot of systems work around that. I think a couple of things that are different with life insurance companies is due to the long-dated nature of our liabilities, we tend to have more of a percentage of derivatives linked to LIBOR, let's say, than other type of institutions like banks. Most of our assets, though, are fixed rate because we are life insurance companies managing long-dated liabilities. So that's one difference. The other difference in the United States is that we're regulated in every state that we do business. So in theory, we have to reach out to 50 regulators and educate them about this. And I think that's a very important process, but that's probably something that an FDIC or excuse me, a Fed-regulated bank doesn't necessarily have to deal with.
Okay, thank you, Jason. And then Wells, and I'll come back to Jason on this one as well. So Fannie Mae recently did an offering. So could you talk a little bit about why you chose to do it now, what you saw as the advantages, any special considerations?
Sure. So in July, we issued the first ever floating rate note in the markets that was indexed to SOFR. It was based on a lengthy process. Obviously, we've been focused on this issue for many years now. We arrived at the conclusion earlier this year that SOFR was an appropriate rate for floating rate debt. We started talking to dealers. We started talking to investors. We made sure that they understood the product, they could consume the product, they could model it out. We also had to make sure that we were operationally ready. I mean, this is an entirely new reference rate. You can't underestimate how much of a lift it is for folks to update their operations and their internal processes. So once we were comfortable with all those aspects, we brought the deal to market. It was very well received. We did 3 bond issuances aggregating $6 billion. We were oversubscribed by investors. We had a broad base of investors, both from ARC firms and non-ARC firms. So that's good that you had awareness from some of the institutional investors that weren't, intimately involved with what the ARC's doing. The challenge is really operational, first of all, just raising awareness internally, and know that it's going to take some time. There have been a lot of other issuers now who have stepped in, but I wouldn't say that it's so standardized that you can take the process for granted. You really do need to do the work internally with your external advisors, with the dealers, and with the investors. We saw this as an opportunity to help advance SOFR and advance the goals of the ARC. So we seized the opportunity. It went really well, and we're pleased that others have followed suit.
And were there any surprises in terms of either the investor reactions or in terms of those pesky operational issues you mentioned?
There were a handful of pesky operational issues, but there was nothing nothing we couldn't handle. There was a lot more legal focus than you would also imagine. Typically, when Fannie Mae issues debt, we don't hear from too many folks, whether it's dealers, counsel, whether it's the investors. I was getting a lot of calls from investors and then looping in their in-house legal department saying, how exactly does this rate work? When do we calculate it? When do we stop the rate and do a suspension period so that you can actually calculate the rate for that interest period? How do we want this to work and how do we model this out? And then those fun other issues like what if interest rates go negative? How do we handle it for this product? There's just a variety of things and just scoping out the risk for folks and being clear with your disclosure and being clear what the product is so that the markets can consume it, and if folks need to hedge it, they can hedge it as well. Those were all readily topics that we could handle, but definitely required a lot more attention than a plain vanilla deal.
Thank you. Now, Jason, as you mentioned, you've been an issuer as well. What takeaways did you have?
Well, I want to give credit and kudos to Fannie Mae for helping us ease our issuance because they were the front runner. Right. But it was still a 2-month process for us, and we worked very closely with our underwriters, and kudos to our lead underwriter who literally went to investors on a no-name basis to make sure that our deal would be successful. Some of the same issues, we need to make sure that that our systems we could book in our systems, which again 2 months was plenty of lead time. But the pressure was on because I wanted to be the first, not only the first insurance company, but the first corporate issuer to issue a SOFR note, and you guys made us run a little faster. One thing that we did, again, I mentioned we're regulated at the state level. In 50 states, the issuing entity is a New York domiciled insurer. We felt it was prudent to reach out to our regulator and advise them what we were doing. And that was something that I think it was good we did because there clearly was an education process. And they were very supportive. But that, I don't think we would have, it probably would have been taken us longer had we not done that, because that education process, the questions they asked, help us really think and get our documentation in order and do all the things we need to do to be prepared to do it. So I was a little nervous. We issued the Thursday before Labor Day. It was good and bad. It was good because we had a lot of investor focus, and we were very surprised that we launched a $500 million deal. The book was 2 times oversubscribed, and we ended up doing $1 billion. At the peak, we had like almost $2 billion of orders. And we had the broadest investor base that we've had in a floating rate deal in a long time. So it was very successful. Brought in new investors, and we're very happy, very pleased. We like the SOFR index as a liability issuer because we don't want to have our liability tied to a bank credit. We're an insurance company. Why would we want bank credit involved? So,
Fair enough. Well, so let me come back to you. I've heard Fannie Mae does a lot with mortgages. Do you have any comments you'd like to make about LIBOR and mortgages and transition to SOFR beyond the issuance that you were just talking
Can
about?
I say no?
You can say no. You're allowed to. I'm sure other people here would be happy to talk.
I think my friend David Bowman did a nice job of setting the table for me. I think of it sort of in 2 or 3 phases. We've talked a lot about the ARC and ISDA have put out triggers and fallbacks for what happens if LIBOR goes away while you're still originating new LIBOR loans and issuing new LIBOR deals. When we're talking about our products that are consumer facing, so adjustable rate mortgages, someone selling us hundreds or thousands of loans, all we are is an intermediary that forms a security, puts a guarantee on it, and puts that out to investors. We're just passing through whatever the interest rate is. If you tell someone, hey, your adjustable rate mortgage is going to be based on 12-month LIBOR, 6-month LIBOR, but if LIBOR goes away based on these 5 events, you could fall back to these 4 interest rates and have 3 spreads. How does anyone understand that? So that's part of the reason why we haven't changed the language of our note for the adjustable rate mortgage. And you want everything to sync up between the investors on the one side and the borrowers on the other side. So that's the challenge with going forward. In terms of legacy deals, David hit the nail right on the head. For those, unless you go and reach out to every single borrower in a security and say, hey, I'm changing your rate from LIBOR to something else, which will never happen, let's face it, it's hard to get anyone to return your call. You have to rely on the function of the documents. And fortunately for the government-sponsored enterprises, we actually had good fallback language, which is if LIBOR becomes unavailable, then you move to a comparable index selected by the note holder, which is Fannie, Freddie, et cetera, based on comparable information. The one problem with all that is what's comparable and how do you determine that? And let's make sure there's fairness for everyone. We don't want a wealth transfer. We're just an intermediary. We want borrowers to be in a rate that's appropriate for them and that's going to perform with their expectations. We want the investors to have a rate that's in line. And we also realize we're not the only ones in the ecosystem. You've got servicers, you've got trustees, you've got other transaction parties who in some cases aren't being paid a lot of money, but there's real litigation exposure there. And so that's one thing that you have to be very prudent about how you move away from LIBOR if LIBOR ever ceases. And honestly, that's also where we could use help from regulators. They can make the transition from LIBOR to whatever it is a lot easier for all of us.
Well, thank you. And thank you all, by the way, for both very clear and very concise answers. We only ran about 45 seconds over, and that's mostly because I didn't want to stop Wells as you were explaining a very important set of issues. So we're open now. Sir? And by the way, could all of you just say your name and what organization you're with, if you're with an organization?
Thank you. I'm Carl Pulser, and going back to the opening comments, most of my early education was in Louisville in Indiana, so take this as an unsophisticated Main Street question. It was interesting to hear that a lot of the problems with LIBOR occurred in a time of financial crisis, and yet we're talking a lot about business as usual times. I was just at a meeting where some members of the Fed were talking about accepting as a normal tool negative interest rates in their armamentarium. what about, how would this new system function? Has it been stress tested for a future financial crisis? Has anybody thought about that, like with regard to very low interest rates or those kinds of things?
It's a good set of questions. And let me make one point that may be implicit in your question, which is the response by the authorities is not just because of what happened during the stress period. It's because the market has dramatically changed. It used to be that banks actually did lend each other money in a way that lent itself to having an index. Now, to a large extent, it's a guess as to what would we have to pay at these different maturities if we were actually to borrow. So there's that issue. One of the reasons you're seeing the momentum forward is because the problems with LIBOR are so clear. But since we've got an entirely new rate, I don't think we know how it's going to perform in the future. We have some idea maybe, but
But I
please.
think we know a couple things. We
Yeah.
know it's much more robust. We know
Yeah.
there's like $500 million of trading in
Yeah.
LIBOR. We know there's
Exactly.
$800 billion of daily trading in the repos that make up SOFR. Those have been around a long time. So you can see how the components have performed through the crisis. So I think that's
Absolutely.
important to know that this is actually a real rate that's bigger and more robust. I think the second thing is when you get to products like the loan space, we do have, you were talking about negative interest rates, we do have language in loan documents that the interest rate doesn't go below zero. So we have sort of a natural stabilization aspect there. So I think there are structures built into cash market products that stabilize it.
Okay. Other questions? I guess one more, in fact, is what I'm told.
Yeah, this is just a follow-up on what Will's, I think, ended with, and this is really for the whole panel. Do you think that there should be precise regulator and parameter put on whatever the solution is that comes out of the ARC, for example, for the various fallbacks? I know that everyone wants this to be a market-based solution, and I don't think David would want to sort of commit to sort of saying that they're blessing this. But how do you prevent, especially in cases where there's discretion either by a lender or by a counterparty to set a certain rate, that there won't be lawsuits? And it goes beyond just the bank regulators, but could also be somebody like the CFPB and the like. Do they need to step in and say this is a reasonable way to go?
Yeah, anyone?
I mean, I would say, and here I'm speaking for myself, not my members, I think in the long run, you'd want to keep it as best practices as possible, as market-based as possible, because I think just trying to sort through all the issues we have right now, I think you can't necessarily contemplate, forecast issues that come up, and my concern is that if there is a kind of strict regulatory guidance, things will just continue to come up that require additional questions to be answered, concerns to be sorted through. So I worry about there being something completely, very formalized without some discretion. But on the flip side, and as I mentioned earlier, you don't want too much discretion in the way this is all sorted out because you have the liability risk. But my gut reaction is that we would prefer to keep it kind of market driven and best practices driven, and then as the market evolves, we certainly expect the industry participants to kind of update their policies and procedures and language moving forward. But
the one thing I would add to that is if you look at the ARC working group, so Syra runs a working group, I run a working group with the ABA, and what we have in that working group is we've got 50 institutions, sell side, buy side, borrowers, market experts. So the idea is we're bringing the market together to develop proposals that hopefully work for everyone, if not perfectly. And as far as the discretion point is concerned, one of our proposals is what we call a hardwired approach, which says at the origination of a new credit agreement, you define all the terms of how you fall back. And once you've defined it up front, that means there isn't gamesmanship when the actual transition occurs. So if we can move to that model, without the Fed requiring us to move to that model, but if we can move to that model, that means the risk of litigation has declined, the risk of uncertainty has declined. And again, we have many people in the room with different views discussing this.
Perfect timing. So thank you all, and thank you very much for the panel.